Two people can make the exact same financial decision, and one feels free while the other feels trapped. Same income, same house, same mortgage. Completely different outcomes, psychologically and financially. Today, we're tackling one of the hardest money questions there is. Once you have a mortgage, should extra money go toward paying it off or into investing? And no, the answer is not what TikTok, Reddit, or finance Twitter tells you.
The real dilemma. Let's ground this in a realistic situation. You buy a home with a $500,000 mortgage, 30 years, 7% interest. Monthly payment approximately $3,327, principal plus interest only. After a year, life improves. You get a raise, a new job, or a side hustle takes off. Now you've got $1,000 per month extra. That's when the mental tug-of-war starts. One voice says, kill the mortgage, guaranteed savings. The other says, the market averages way more than 7%, invest it. Both sound smart. Only one is incomplete.
Let's say you invest that extra money every month into a broad stock index. We'll be conservative. 9% annual return, contributions grow 3% per year, investing starts after year 1 and runs for 29 years. Run the math and you end up with roughly $1.83 million. That's serious money. At face value, investing looks like a runaway winner. But this assumes the market behaves politely. It doesn't.
The thing mortgages do that people underestimate. Before we go further, you need to understand how mortgages actually work. Early on, you're not really paying down the house, you're paying the bank. On a 7% mortgage, in your first year, most of your payment is interest. After 12 months, your balance barely moves. It takes decades before principal dominates the payment. This matters because extra payments behave very differently. Every extra dollar skips interest entirely, reduces future interest forever, acts like a risk-free return equal to your mortgage rate. At 7%, that's not trivial.
Option 2. Aggressively pay down the mortgage. Now let's flip the strategy. You put the full $1,000 per month toward the mortgage instead. Starts in month 13, increases 3% annually. Result: mortgage paid off in 16 years. Interest paid drops by roughly $380,000. But here's the honest accounting. You spent about $238,000 extra to achieve that. Net benefit equals $142,000. That's good, but nowhere near $1.8 million. So investing wins, right? Not yet.
The missing variable: what happens after the mortgage is gone? Once the mortgage is paid off early, something huge changes. Your cash flow explodes. Instead of sending money to the bank, you now have your former mortgage payment plus the $1,000 you were already using. That's about $4,300 a month available to invest. If you invest that for the remaining 14 years at the same 9% return, you end up with $1.19 million. Add back the interest savings and your total comes to $1.33 million. Still less than investing from day one, but much closer.
Why spreadsheets lie to people? Here's where most analysis stops. And it's a mistake, because markets don't deliver smooth returns. Sequence risk. If your early investing years coincide with a crash, a flat decade, high volatility, your real-world returns can be dramatically lower than averages. Mortgage prepayment doesn't have this problem. Paying down a 7% loan gives you a guaranteed, tax-free, volatility-free 7% return. That's rare.
The hybrid strategy. This is the real answer. Instead of treating this as a binary choice, think of it as risk balancing. I call this the freedom fund approach. You split your extra money between buying future freedom, investing, reducing financial obligation, debt payoff. Some ways to do it: 50-50 split for balance, more investing when young, more prepayment later. Rate-based rule: above 8%, lean toward payoff. Below 4%, lean toward investing. Between 4 and 8%, do both. When you run the numbers on a split strategy, you end up with less maximum wealth, more stability, earlier mortgage freedom, better sleep. That trade-off is intentional.
When math takes a backseat. There are times when the optimal spreadsheet answer is irrelevant. You should prioritize paying down debt if you're close to retirement, your income isn't stable. Debt causes real anxiety. You want flexibility in monthly expenses. You should prioritize investing if your rate is very low, you're early in your career, you lack liquid assets, you haven't maxed retirement matches. Neither path is morally or financially superior. They're just different priorities.
The real decision. Two people can live in the same house and feel totally different about it. One sees security. The other sees obligation. Money decisions aren't just about returns. They're about identity, stress, and control. So before you choose, forget what influencers say. Forget what worked for someone else. Decide what freedom means to you. Then use the math to support that life, not dictate it. Because there isn't one correct answer. There's just your answer. And if you make it deliberately, you're already ahead.